The hot topic on markets now is inflation. Is it transitory as the Fed assures us, or is it history? Let's cut to the chase. It is likely to be persistent and significant, and it will have important consequences for investment strategies. Core inflation for the month of April came out at 0.9% month on month, up from 0.3% month on month in March. The last time we saw a higher figure was in 1982, when then Fed Chair Paul Volcker was forced to take a hammer to break the back of US inflation. The 12-month core inflation figure is now 3%, up dramatically from 1.6% for the 12 months to March. Now, here are three reasons why this inflation problem won't go away in a hurry. 1. There is this long US history of high inflation following on or coinciding with periods of high money supply growth. We have seen this movie before many times. During the so-called Long Depression of the 19th century, the New Deal stimulus of 1933-36, during the Second World War, and during the Vietnam War. Now, note the theme: monetary expansion to finance recovery from economic crisis and wars. And here we are now in the midst of another economic crisis and a war against a virus. So since the start of last year, we have seen a period of the greatest monetary expansion in US history, and it isn't even over yet. Point 2. We now appear to be in the early stages of a new commodity cycle that started last year, with likely added vigor caused by fiscal stimulus in the world's two largest economies, the US and China. The infrastructure spending in these two economies will likely drive competition for commodities, inventory building, and yet higher prices. Point 3. Supply chain disruptions caused by the pandemic and higher tariffs imposed by the US and China on one another will add that little bit more to prices. So what should investors do? Well, the first thing to do is to accelerate that rotation trade away from tech to all economy sectors such as financials, industrials, materials, energy, and real estate. Next, buy inflation hedges, gold and commodities. And within emerging market stocks, discriminate in favor of those countries which have been effective pandemic managers, where inflation is relatively mild, and which have large exposures to commodities. We favor China for its efficient handling of the pandemic, its moderate inflation, and its robust economic growth. We also like Indonesia. It has one of the lowest rates of COVID-19 infection per million of population in the emerging markets, way below the likes of Brazil, Russia, South Africa, and Malaysia. Its inflation is also modest. 60% of its exports are in commodities. Now, South Korea's inflation looks worrying, but we like it as a special play on the shortage of that digital economy commodity, semiconductors. Australia? Well, it's a non-emerging market, but Asia-Pacific play. It's just about eliminated the virus within the community. It has only moderate inflation, and more than half its exports are commodities.